Welcome back to Owners Club. John here, and today we're diving into the wild ride that was the stock market last week. From economic data shakeups to global influences and some big earning reports. A lot went down, so let's break it all down so you can stay ahead of the curve. So let's start with the big picture. Last week was a roller coaster for the stock market. A lot of ups and downs driven by some different key economic factors. First up, economic data played a huge role. Early in the week, there was a new payroll and unemployment report that showed an unexpected rise in unemployment. This sparked fears of economic slowdown, leading to a market sell-off as investors worried that the Fed might have to cut interest rates more aggressively than expected. If you want to know about how the Fed controls interest rates, check out my video here. But it wasn't just US data moving the market. Global factors, especially from Japan, added to that volatility. The Bank of Japan recently hiked their interest rates, which led to a lot of turbulence, particularly because of the unwinding of what's called the yen carry trades. Now, carry trades are where investors borrow in a currency with a low interest rate and then take those proceeds and invest it into one with a higher interest rate. So hedge funds and professional investors were borrowing the yen at almost a 0% interest rate and then investing that into higher return investments like stocks or government bonds, for an example, that have a guaranteed return of at least 5%. So the change in the Japanese interest rate caused margins to be called on those borrowed assets, which means the borrowers needed to put out more collateral to cover the amounts that they borrow. So to cover the margin cost, the hedge funds needed to sell out of other assets, which are mainly going to be stocks, which they had a very good run return on over the past year or so. So the mass selling caused a ripple effect that hit markets worldwide. By the end of the week, Japan market had bounced back after some further announcements from the Japan Central Bank, which helped stabilize things a little bit more. So looking at different sectors, it was a mixed bag. Tech stocks, which have been under pressure lately, continue to struggle. In fact, the Nasdaq logged its fourth straight week of declines, led by stocks like Apple and Nvidia. So Apple saw a sell-off as Warren Buffett, maybe the greatest investor of all time, sold half of the shares he owned, which are around $85 billion. So this made up about 30% of his portfolio. And this is important because it could possibly signal that Buffett sees the stock market as being more risky in the coming future and is deciding to lower that risk by selling off some of his assets in the market. So there was some good news last week, especially when it came around some earning reports. So companies like Expedia, Eli Lilly had better than expected results in their earnings that they reported, which provided a nice boost to the market, particularly in the tech and healthcare sector. However, a huge miss and lowering of future earning expectations by Airbnb did shock the market a bit as it could signal further weakness in the economy for everyday consumers. So all in, it was a week of twists and turns, but despite the rocky start, the major U.S. stock market managed to recover most of their losses by the end of the week. So all in all, it was a week of twists and turns, and despite the rocky start, the major U.S. stock market managed to recover most of their losses by the end of the week. The Nasdaq was slightly down, but considering everything that went on, it could have been much, much worse. And I think investors will take that as a potential light at the end of the tunnel. As always, stay tuned here on Owners Club for more updates and insights. If you found this breakdown helpful, don't forget to like, subscribe, and hit that notification bell so you never miss an update from us. Until next time, take control of your financial future and keep owning your life.